Hello, everybody. So we are almost at the end of February. It's been amazing how fast this year has progressed. Okay, so we are going to jump into another episode of Money Matters with your host Hung Lu. And so we are going to talk about whether or not you should use a higher down payment or a lower down payment. This is a common question that comes up all the time because especially now with this 5% down, it is definitely something worth looking at. So before we jump into that, let me just share, please, if you've got any questions or comments from the sessions I'm doing, please put them in the comment box. Even if it's a negative comment, I still want to hear it. I still want to just get that feedback. I did a session last week about some of the bad deals I've come across. One of them was in Whistler and a couple were in Big White. And I did get a negative comment on that. But hey, you know what? That's all part of the learning. So please feel free to give them to me as they come. Okay. So because really the outcome of these sessions that I'm doing is really to just put out my knowledge out there, but also just to keep the conversation going, sharing what I'm learning with other investors so that we can all sort of make the decisions that's right for us, right? Our families are all in different situations. And so, if it's right for you and your family to buy a place in Whistler or in Big White for 1 week out of the year and pay for that, okay, then go for it. Okay, so really these sessions are really just to give you another opinion. Okay, so we're going to jump into the down payment question because this is coming up quite a bit as to, hey, Hong, you know what? We're allowed 5% down as our primary. Should I put 5% down or should I put more money in it if I have more money? And this is, applicable for single families, but it's also coming up now recently with multifamilies because in some of the multifamilies, we're actually able to put 5% down, which is amazing. 5% down on a multifamily unit so that we could acquire it and then operate it for years and years and years, okay, as a multifamily, which is fantastic. So now here's the thing to consider with this 5% down is yes, you can get into the market. Yes, it's a great, small entry point in consideration, but there's other things that you should think about because with that 5% down, there's some hidden costs that you might not be thinking about. Okay, so let's run through this a little bit and let me just try to get all the information out there. Okay, so let me share the Excel sheet. Let me bring that up. Okay, so on the screen, you'll see an Excel sheet. And, the when I bought my first place, I think I was, at 7 or 8% down. And so for me, that was one of the best investments I've ever made. And so if all you've got is 5%, 7%, less than 20%, I still would suggest that you take a look at the numbers to see if it makes sense. Okay. So the first thing to keep in mind is that if you are putting down less than 20%, one of the things that a lot of people forget about is a premium that you're going to have to pay to get a loan if it's less than 20%. Even if you're allowed 5%, even if you can get away with 10%, you still have this premium. And a lot of people don't consider that in their carrying costs, in their long-term objectives when it comes to where is the money going. Okay. So there's this premium that you have to pay, whether it's residential single family or if it's multifamily. So on the screen, you'll see sort of the breakdown of this. So I'm going to run my example on a residential property. And the reason why I'm going to do residential, because once you understand it at the residential level, it's the same concept with multifamily. Okay. But the reason why I'm focusing on the residential right now is because one of the recent mortgage changes is allowing families to buy properties with about 5% down, going up to 1.5 million, and then getting this insurance premium on it. Okay. Whereas prior to this new change, it was only up to 1 million. And so it makes a difference. Okay. So I want to sort of run the numbers with that, keeping that in mind that, okay, we're talking about the residential, like the small 4 units and less. Okay, that fits under the residential. And then if you go over multifamily side, then yes, you're going to still pay a premium. It's calculated a little bit different, but it's the same calculation. Okay, it's the same concept. Okay, so the thing to consider with this down payment portion is that whatever portion you put in, that is your equity. And the reason why I'm bringing that up is because a lot of times when I um, talk to families about how much equity do you have in your place, they actually don't understand that question. So the equity that you have in your property is whatever your down payment is that you put down, plus whatever your principal pay down has been over the time frame. So if you are just buying this place, well, then you have no principal pay down yet, right? So it's really just whatever your down payment is. But if you've had the place for 5 years, 10 years, whatever time frame, then you would have whatever your down payment was, plus whatever your principal pay down is, assuming you haven't refinanced and taken out some more of your equity. Okay. So there's a couple of ways to calculate that. Okay, so when you put anything less than 20% down, you're going to have to pay a premium on the insurance. And the reason for this insurance is that the banks want protection on lending their money out to you. So it's a higher risk for them for you to put in less money and then they give you a bigger loan. So the more you put down, the less loan they have to give you. So if you think about it logically, there's less risk for them if you put in more money. Okay. So the premium breakdown changes depending on how much you put down. Okay. So you'll see that on here. So if you put less than 10% down, it's a 4% premium. And if you put down less than 15%, it's 3.1. And if you put down less than 20, it's 2.8. So this is almost like the better credit score you have, the better interest rates you'll get because the lenders are taking less of a premium based on your credit score. So it's the same idea. Okay, so let's run through the scenario as to why this makes a difference. Okay, now the thing to keep in mind is, yes, if you put down a smaller down payment, your mortgage amount, you're going to borrow more money. Because you're borrowing more money, your mortgage payments are going to be higher. Okay. So you sort of have to factor that out. Like the more money you put down, like if your down payment is higher, then your mortgage amount goes down. So then you're paying less mortgage. And so, or less principal and interest. So at the end of the month, as an investor, you're actually making a little bit more cash flow because your interest rates or your interest mortgage payment has gone down. Okay. So if you think about it that way. Okay. So let's jump into an example here. So let's go up to $1 million here because a lot of us are not going to be able to find a single family for under 500,000. Okay. So let's run this at $1 million. So if you put 5% down, your down payment is 50,000. Okay. So not a crazy amount compared to what $1 million could be. Okay. So now your mortgage amount is going to be 950,000. What I saw during COVID was a lot of people were getting into situations where they were doing, 5%, 10% down or something like that. And the banks were saying, hey, yeah, you know what? On your $1 million property, we'll give you a $950,000 mortgage. And then as the interest rates were going up, the banks actually came and said, no, Mr. New Homeowner, we're not going to allow you a 5%. We actually you have to do a 10% down. Okay. So keep in mind that what that means now is that now you have to come up with another $50,000. And if you have already signed away your conditions on your purchase, well, you're sort of stuck, right? And there's no recourse for you against the bank because in the fine print, if you read the fine print of the commitment of your mortgage documents, it says basically up until the day that we fund you, up until the day that we advance the money to the lawyers, we can make changes to your mortgage commitment, which is so crazy. Okay, so let's just say, okay, well, let's go back to the 5%. Okay, so now your loan to value is 95%. Okay, so the way I calculated this loan to value is you just take your 950,000 divided by your 1 million. Okay, that is the same calculation for everybody, anybody under any circumstances when you're trying to calculate your loan to value. Okay, now if you're trying to calculate loan to construction, that's slightly different. It's just your construction loan divided by your total construction costs, okay, or your project costs. Okay, so here we're not worrying about that. We're just worrying about your loan to value. Now, some people will call this your LTV. So just to keep that in mind, that's what that stands for, okay? Loan to value, your LTV. Okay, so if you follow me on this calculation here, at a 5% down payment, 5% down payment, we're going to be at a 4% CMHC premium rate on your mortgage. So that means on this 950,000, I'm just going to make this a little bit smaller so you could see it all on one screen. Yeah. So on this $950,000 mortgage, you're going to have to pay $38,000 in a premium fee. That's a lot. Okay, here you think of it, that's a lot. So usually a lot of homeowners don't have this $38,000 just sitting in the cash or in the bank, sitting in cash. So what they'll do is they'll actually add this to the mortgage amount. So now you have a new mortgage loan of 988, and that new mortgage amount is just your 980, sorry, your 950 plus your $38,000. Okay, now if you're saying, Hong, how did you calculate this $38,000? Okay, well, I've got a formula in here that basically says, okay, well, if it's 5%, if it's anything less than 10, then you just multiply your 950 by your 4%. If it's anything less than 15%, then you're going to take 3.1 times your 950. Okay, anything less than 20 is 2.8% times your 950. So it's just a formula that I put in here just to make it easy for myself, because I can just come into the spreadsheet, change this green cell. Okay, so if I put, let's say 10% down here, that's going to change my down payment a little bit. If I go and I put down, let's say 15%, yeah, that will take me to a little bit smaller amount. And basically what I'm doing is I'm just taking this 850 times whatever this percentage is. That's it. Okay, so let me go back to the 5% there. Okay, so let's just say, for example, the interest rates now are around, yeah, some of us are getting around 4.7. Okay, so let's just run it with 5%. And the amortization, I'm going to leave it at 25 just so that you can see the numbers. You are able to get a 30-year amortization with some lenders, okay, but let's just run it at 25. Okay, so 5% interest rate with a 25%, 25-year amortization. So what this tells me here, okay, on this calculation that I've done here, is that my monthly payment, okay, without the CMHC mortgage, sorry, without the CMHC premium insurance, is $5,553 a month. Okay, so if I just stuck to the if I was able to put more down and not have to do the CMHC, or let's just say the CMHC insurance didn't exist at all and there was no premium added to it, okay, I would be paying $5,553. With the premium, it goes up by $222. So now I would be paying $575. And this is assuming that I'm rolling this 38,000 into my loan amount for a total of 988. Okay, so that's why the monthly mortgage payment has gone up just a little bit. Okay, so what that difference is $222, which doesn't seem like a lot of money, especially if you're able to get into your new place and now you've got a property under your belt. Okay. However, what that $222 translates into is an actual $28,000 interest that you have to pay on this property over the time frame. Okay, so that's why if you get your hands on my mortgage book, okay, and in the chat, I'll put in the information on how you can get a complimentary e-version copy of this book. Because if you know how to pay off your mortgage in under 10 years, okay, which is what this book talks about, if you can pay off your mortgage in 10 years and re-leverage it, you can save so much interest, so much money from your pocket. Literally, it boils down to about it boils down to several $100,000. Okay, and that number changes depending on what your mortgage amount is and so forth like that. So that amount that you're saving is a moving target. Okay, so I am dumping that link that you can get a free e-copy of this book. Highly recommend it. It is basically a weekend read. It is a thin book, okay? Not like our new book that just came out that is like 4 times bigger. Like it's yeah, a completely different size. Okay, so the thing to keep in mind when you are looking at doing, let's say, hey, Hong, can I do a 5% down or should I do a 20% down? It really depends on what you're trying to do in terms of, do you have the available cash? If you have the available cash, it might make sense to look at doing the higher down payment. But if you don't have the cash, well, then it's sort of a moot point, right? Then really get into the market. Okay, so now the thing to keep in mind is that when you are doing a smaller down payment, so like a 5% versus the 20%. Now, I don't recommend going higher than the 20%. Like if you have to do 25, then fine, do 25. But I don't recommend going more, like 50% or 60% more, because you're tying up capital that you could deploy somewhere else. Okay. The cost of borrowing is still fairly low compared to what we saw in the late 80s, early 90s, where the interest rates were like 12, 15, 18%. 5% is still so cheap. Okay, so if you can do the 20%, do that. But if not, then do whatever you're able to get to get by with. Okay, so now when you do a lower down payment, your mortgage amount is going to go up. So that means that your monthly payment's going to go up, which we saw over here with, okay, like even if you don't look at the CMHC, here we can go here. So at $950, your monthly payment is 5,500. If I go up to the 20%, you could see that your monthly payment now is 4,600. So you're almost saving $850 a month in payments on your property. Okay. As an investor, we look at that as a tax deductible expense because we get to write off the interest. Completely different side story. But what you want to just keep in mind is that $850 a month that you're saving is adding right to your bottom line, because that's not an expense that you have to pay out. And so that's an increase to your cash flow every single month. Okay. So you definitely want to consider that. The benefit of being able to do this 5% or less than 20% is that if you're trying to aggressively acquire properties, well, then you don't want to tie up your capital, right? The more you can sort of spread it across multiple properties, you're sort of diversifying your risk a little bit. Okay, but now the thing to keep in mind, so the negative side of having this 5% down is, besides the fact that your monthly payments go up, so you have less cash flow, you have to pay a premium, okay, for the insurance, for the mortgage. But the other downside is that this equity, right? It's 5% equity. If your market goes down, like, we've seen that across some marketplaces, if your market goes down and your $1 million value property goes down to, let's say, 950, you now have no equity. You still owe 950 to the bank. Okay, so for example, like in Fort Mac, after the fire, and I don't know what else happened up there to create all this market downturn in Fort Mac, But basically, people had properties up there that were way less than what their mortgage amount was. So basically, whatever equity they built up to that point was out the window, like no more equity. Okay. Which is a sucky place to be, regardless if it's a residential home or multifamily as an investor, like totally sucks. Okay. Okay, so what else can I actually tell you guys about this? I think that's pretty much it, right? If you can pay down your mortgage as quickly as possible and then re-leverage that and get out of this premium, okay, that is definitely something worth to consider. Okay, so that is all I have for you guys today. Thank you so very much for tuning in to another episode of Money Matters with Hung Lu at Cash Property. And please get your hands on this book. It is a free resource. It doesn't cost you anything for this book. Okay, especially it's an e-version. Okay, thank you, everybody. Have a fabulous week.